Okay, I'm going to talk about a traditional IRA, a traditional individual retirement account, as you will need to know it to pass your life insurance pre-licensing exam. You get your life insurance license. If you find value in this, subscribe to the channel, turn on post notifications, that whole nine. So an individual retirement account, or an IRA, it's more commonly known. Anyone with earned income, or anyone who claims income on taxes, can contribute to an IRA. So earned income is income you pay taxes on. Now, there was an act in 2019, and what happened in 2019 is the Secures Act of 2019. It made it so that people can contribute up until they are 72. Before that, the oldest you could contribute was 70.5 years old. Now, anybody at any age can contribute to an IRA. And what it is, it's an account where you can put money in and have it write off on your taxes. It's tax deductible contributions. So the Secure Act also made it so that people have to start receiving contributions for it at age 72 instead of 70.5 years old. So they used to have it as well, where you'd have to start receiving distributions from that account. So what an IRA is, it's an account that you can put money into, and it will grow and grow and grow and grow and grow, and it's supposed to be a retirement account, individual retirement account. So the IRS essentially struck a deal with Wall Street and said, hey, you know what, we're going to let everybody just like store their money somewhere so Wall Street can play with it until they retire and tell them that it's good for them. Whole nother subject. But someone can, what it really is, you can put your money in an account so that you can, it's to save up for retirement. It's a good incentive to save up for retirement too, okay? So what tax deductible means is that, say you have $100,000 income and you put $5,000 into an individual IRA from your pre-tax income, you're only going to pay tax on $95,000 if that's all that you write off on your taxes, okay? So it lowers the taxable income. Now, there are limits every year. This is 2022 right now, so this video may get dated, but I think the maximum contribution per year right now is $6,000. I could be wrong, but I believe it's around $6,000. You're going to want to Google that and check it out. So essentially, anybody with income can do it. So say I'm like, right now I'm 32, I want to put $6,000 into my IRA to put towards retirement, and then that money can be invested however I want it to be invested. But it's tax deductible. Now, people 50 plus, people who are over 50 years old, can make catch-up contributions. So say right now I only put in $1,000 for this year. When I'm 50 or older, I can make up for this year and put the limit when I'm 50 plus the amount that I missed from this year. So it would be $5,000 difference if the limit is $6,000. So I'm going to look actually up what it is right now. Let me see here. IRS limit 2022, IRA limit 2022, $6,000. Yep. So it's $7,000 if you're over 50. Okay, so say I put in $1,000 this year and I don't max it out at the $6,000 deduction or contribution. Then when I'm over 50, I can put an extra $5,000 to make up for this year. Okay, so after 50, you can catch up if you want, put extra in. All right. Now there's a dollar limit each year, but the max for this year is $6,000 unless I make less than $6,000 a year, and then I can contribute all of my income to that. Also, there was a year where people had to receive, I'll cover that in a second here. But so married couples, so say someone's married, and say I was married, and my wife didn't work. I could essentially have her set up an account, even though she didn't have earned income, since I'm claimed as married on taxes, I can have two IRAs in that sense. So I could actually set up one for me, and then she could have her own account and use my income to fund it. So I can actually I would double what I could contribute to $12,000, even though she didn't have any earned income. Technically, we had earned income on our taxes because we're married, okay? So this counts as two people. So it's important for this, both need separate accounts, but you can only do that if you're married. The owner can withdraw funds at any time. So like I can withdraw funds from my IRA at any time, but if I withdraw them before ages 59 and a half, before I turn 59 and a half, there's an extra 10% withdrawal tax penalty. So remember, I put all the money in pre-tax. I didn't pay tax on that money yet. When I take the money out, I have to pay income tax on the money that I take out. But if I take it out before I'm 59 and a half years old, I pay an additional 10% tax on that as a penalty. And by the time I turn 72, I can still contribute to it, but I have to take a required minimum distribution. It's called an RMD. So there's a minimum amount that I have to take from it when I'm 72 years old as a distribution, even though I can keep putting into it. Okay. Now this is tax deductible. So once again, I make $100,000. I put $6,000 into my IRA. My taxable income is now $94,000. $6,000 was deducted from my taxable income. That's why it's called a deductible contribution or tax deductible contribution, because my contribution is deducted from my income that is taxed. All right. There are certain situations where withdrawals from an IRA are not subject to tax. So there's certain situations when someone can take money out of it and they don't pay tax on it. One is if they are over 59.5 years old, obviously, because if they're under 59.5, then they may have to, unless they're totally disabled. So if they're totally disabled, they can access the funds from their IRA. Also, if the money is used to make a down payment on a home, not to exceed $10,000, usually for a first-time home ownership, so they can take $10,000 and there's no tax on it. And for post-secondary education expenses, like if they want to go to get a master's degree or something like that, or for catastrophic medical situations or upon death. Yeah, tax-deferred growth. So it means you pay taxes on your investment gains when you make withdrawals. Yeah, that's what I thought. I don't know why. Something in the course, what I was reading, essentially the course I'm reading, the charts were all kind of didn't format right. But yes, so tax-deferred. So say I put that $6,000 in and it keeps earning interest in an account somewhere. I want to invest it in some mutual funds. This is not investment advice, disclosure. But it keeps growing, right? Tax-deferred. I don't pay any tax as it's earning interest, right? You know how you pay tax on your interest in your savings account every year, even though it's such a small amount, you may not even notice the amount of interest or tax you're paying, since the interest is so little. But I put that $6,000 in, it keeps growing, and I don't pay any tax until I withdraw it. Now, when I withdraw it, I pay income tax on the amount that I withdraw. So that's the basics of a traditional IRA. Anybody can contribute as long as you have earned income. In 2022, the max that you can contribute is $6,000. That may change in 2023. At this point, you have to take required minimum distributions at age 72. Okay, if you take a withdrawal before age 59.5, meaning you take money at it before age 59.5, then you pay an additional 10% tax on it. And there's no longer a limit on how old you have to be to contribute to it. You can contribute to it as long as you live. So that's a summary of a traditional IRA. If you want to learn about the other types of retirement plans, watch this whole playlist. Find the playlist that this video is involved in. I'm going to put it here at the end of this video. And also, you want to watch the next video on how to, if you want to learn about all the different life insurance policies you'll need to know about for your life insurance pre-licensing exam.